everyone, and welcome. I'm Janelle Blakely, Chief Philanthropy Officer at the Seattle Public Library Foundation. Thank you so much for joining us today and for supporting two of our city's incredible institutions, the library and town hall. Now, this webinar series has been a long-standing collaboration with our wonderful partners at the King County Library System Foundation, the Snow Isle Libraries Foundation, and others who share a commitment to strengthening libraries and learning in our region. And we're especially excited to partner with Town Hall today. I'm grateful to be with you today as I am a new staff person at the foundation, just 3 months in, and I'm looking forward to getting to know many of you in the months and years ahead. Before we move on, I would love to turn it over to Jenna Weitzman from Town Hall for a brief introduction.
Hi, everybody. Thanks for being here today. I'm Jenna Weitzman. I'm the Membership and Annual Fund Manager at Town Hall Seattle. So on behalf of the whole Town Hall team, thanks for coming and thank you so much to the Seattle Public Library Foundation for partnering with us. If you have any questions about Town Hall, we're an arts nonprofit venue in First Hill. And if you have any questions about planned giving, you can let me know. I'll drop my email in the chat. And thanks again, and back to Janelle for this awesome presentation.
Thanks so much, Jenna. Now, each time we host one of these webinars, we're reminded how transformational legacy giving can be. These gifts help ensure that organizations like ours remain vibrant, accessible, and responsive to our communities for generations to come. Anyone who chooses to include an estate gift is invited to be part of the Library Foundation's Legacy Society, and this is a special group of supporters who share a lasting commitment to the future of our library. If you've already included the library in your plans, thank you. Or if you're simply curious about estate gifts, endowments, or other ways to create a meaningful legacy, we would love to connect with you. And our contact information will be on screen at the end of today's presentation. A few quick things before we kick things off. First, we are recording this session, and you will receive a link to the recording and slides after we wrap up. Our fantastic speaker, Teresa Byers, who you will meet in a moment, will be answering your questions throughout and at the end of the presentation. If you think of a question you'd like to ask, please use the Q&A box down at the bottom of your screen to make sure that we'll see it. And if you see a question that you really like and you especially want answered, or that you've been wondering yourself, you can use the little thumbs up button next to the question to upvote it. And this will help Teresa sort the questions so that she knows the ones that are most popular. Finally, when you sign off today, you will be invited to take a very short survey about your experience, and we really hope that you will complete this. It helps us shape future events and webinars. And to sweeten the deal, everyone who completes the survey will be entered in a drawing to win raffle prizes, which may be a bag of books. Now I'm going to invite our speaker, Teresa Byers, to join us on screen. Teresa is an attorney at Ogden, Murphy, Wallace, PLLC. She specializes in estate planning, probate, and estate litigation. And we're thrilled to have Teresa back with us today to share her presentation all about charitable giving. And with that, Teresa, take it away.
Thank you so much. Welcome, everyone, and thanks for taking time over your lunch hour to hang out with me. Our goal today is to talk a little bit about charitable giving. I am going to keep this light and not necessarily be telling you how to update your particular estate plan. I'll remind you to do that with your individual counsel, but hopefully I can put some ideas out there for you, as well as maybe help you think about some things you haven't tried before. So with that, I'm going to go ahead and share my screen, and you all just have to bear with for just a sec as it comes up. All right. So thinking about charitable giving and the fact that this is an area where it really makes sense to say you can't take it with you. And I thought, we would start today by talking a little bit about the trends in charitable giving. Because regardless of where you individually fall in those trends, the trend analysis is what's used by folks in politics and other positions to determine how charitable giving will be treated by the tax code. And so that can have pretty significant effects on people's behavior. And then we'll talk about what I call the complexity continuum of charitable giving. So we'll start with what I think of as the easiest and most approachable types of charitable giving and work our way toward the fancier stuff. So let's talk a little bit about charitable giving, specifically in the United States today. I acknowledge that some people give internationally, but I'm really focused on US charitable giving for this purpose. So in 2024, there was over $592 billion in charitable giving, and 2/3 of all of those contributions are from individual donors like you. So that tells you what an important part of charitable giving each and every one of you as an individual is. Historically speaking, it had been the case that older individuals gave more. Currently, household income is actually a better predictor of giving, and more giving is coming from high net worth donors. That also probably means that the giving itself is more concentrated among the recipient organizations. So there's probably a smaller group of favored organizations by those high net worth donors, as opposed to more of our local organizations, which we've seen some of those have been struggling a bit. The loss of charitable deductions for non-itemizers. So when this happened several years ago with federal tax reform, when it became the case that if you were taking the standard deduction on your income tax return, you could no longer take charitable deductions. And so unless you decided to switch over to becoming an itemizer, which 86% of people in the US take the standard deduction. So it's actually a relatively small percentage of people who itemize their deductions. And that loss of charitable deductions for non-itemizers resulted in about $20 billion being lost in charitable giving. So it was a significant loss. People were not seeing the benefits of giving those gifts on their own income tax returns, and so they had perhaps a reduced incentive to give. Nonetheless, 68% of donors cite their beliefs and values as the primary motivating factor for why they give. So it is still the majority of people who are giving in reflection of some sort of core value system, as opposed to for that nice income tax deduction. So let's talk a little bit about the benefits of lifetime giving. This is what I think of as the easiest type of charitable giving. This is when you write a check, you do a Zelle payment, you transfer some stock, maybe you make a donation of some personal property directly to an organization during your lifetime. And why might you want to do that? Well, one is you can observe the results of your gift. So if you are choosing to give to an organization like the library system that supports summer reading, for instance, you're going to have the opportunity to hear about and see the results of summer reading while you're still here and with us. Another reason people like lifetime gifting is it can make a big difference on your income tax return. So if you are an itemizer, you might want to see the benefits of that. It's a direct reduction in your taxable income. If you're someone who is inclined to give in such a way that you want to give more than, say, $1,000 annually, which starting in 2026, we're bringing back that income tax deduction for non-itemizers, but we're limiting it to $1,000. So if you're someone who likes to give more than $1,000, but less than 20% of your adjusted gross income, you might be someone who is a non-itemizer in most years. And so for folks who are interested in nonetheless reaping some of the income tax benefits, what some clients are choosing to do is what's called bunching of their charitable giving. So they're saving up till the end of the year, and they're actually making 2 years or 3 years worth of gifts to the organizations of their choice at one time. And that allows them to then itemize for that year in which they've made what looks like a much larger gift, 2 to 3 times what they would normally give, and be able to itemize on their tax return that year and get the full benefit of the charitable deduction. The other thing that we're seeing with a lot of lifetime givers is the use of qualified charitable deductions. So when retirement accounts, IRAs in particular, came into being, they were not a primary source of people's wealth. But in combination of now the long-term use of IRAs, individual retirement accounts, as well as the growth in the stock market, we have many people who are finding that these retirement assets are a significant portion of their wealth. They are required to take required minimum distributions on this wealth after they reach 70 and a half. And it may be that they don't need those required minimum distributions, or that taking those required minimum distributions is going to push them up into a higher tax bracket that they don't want to be pushed into. And so we now allow for qualified charitable deductions to be made directly from IRAs to qualified charitable beneficiaries. The limit on that in 2026 is $111,000. So this can be a really significant way for people to make charitable gifts and at the same time reduce their taxable income. It's noteworthy that you don't get to both reduce your taxable income and take the charitable deduction on the same money. So if you're making the qualified charitable deductions directly over and not including it in your income, that's your benefit there. The other reason I really like lifetime gifting is because from an estate tax planning perspective, making gifts during your life can simplify your estate planning. And that happens in a couple of ways. One, if we don't need to administer charitable gifts after your death, that's one less administrative step for us. That's one less notice to a beneficiary that needs to be given. One less beneficiary that we need to follow up with and provide accountings for. It also reduces the gross size of your estate. So if you make a charitable gift right before you pass away that takes you below the filing threshold for the Washington State estate tax exclusion, for instance, we now no longer have those assets in your estate when you die. You're now below the exemption amount, and we no longer have a filing obligation. If you hold that contribution until after your death, it is deductible for estate tax purposes, but if including it in your estate means that you're over the exemption, we still have to file the estate tax return. So you don't have the estate tax liability, but you just have the administrative cost associated with holding that wealth until your death. So lifetime gifting has some benefits in terms of your current income taxes. It has benefits in terms of what you get to witness during your lifetime. And it has benefits for easing the administration of your estate, including the easing of filing estate tax returns, whether those be Washington State estate tax returns or federal estate tax returns upon your death. So let's talk next about a type of transfer that occurs after you've passed. So what I'm talking about generally here are transfers that occur by beneficiary designation. These are otherwise called non-probate transfers. These are transfers that are not included in your will or revocable trust, and instead they're done by use of a beneficiary designation. Most people are familiar with beneficiary designations on their retirement accounts, like their IRAs, their 401ks, or their life insurance. And each of these are essentially a contractual agreement you have with the custodian who holds those assets. So the life insurance company, the financial institution who manages your retirement account. And it is a contractual agreement whereby you designate a transfer of the remaining funds in those accounts or of that policy to be effective only upon your death. So you can change this anytime up until you pass away. And it's relatively easy. It used to be that these forms had to be filled out in person and often with a notary. And now sometimes you can sign right into your accounts online and you just update your beneficiary designation form. Most of the forms do allow for multiple beneficiaries. So you can name, for instance, half of an account to go to your spouse or your children and half to go to a charitable organization. You can submit custom designations. Usually it'll be something that's a little harder to do than just the online form, but there's usually an email address or a fax number you can submit custom designations to. So if you wanted to do something like, I would like to leave the larger of $10,000 or 10% of my estate to charity, you can develop those types of custom designations. What's really nice about non-probate transfers is these have the benefit that I talked a little bit about with lifetime giving, which is that they don't have to go through the administration process when you die. So these assets don't need to go through probate. They don't require notice to heirs. They are subject to claims of your estate if they are not retirement accounts. And they do need to be included in the calculation of your gross estate for estate tax purposes. But again, if you're giving it to charity, you're going to get the corresponding charitable deduction. But it is really nice, particularly in the modern day and age where Washington State has a $3 million estate tax exemption, and it's taking about 18 months to 2 years for Department of Revenue to review estate tax returns after the return is submitted, which is 9 months after date of death. So we're looking at about 3 years to get tax clearance on some estates. So it can be nice for charitable organizations to receive those funds much sooner after your death rather than waiting for the administrative process to be completely cleaned up. It's also important to note, and again, this is for income tax deferred accounts like IRAs and 401ks, that charitable beneficiaries don't have to pay the deferred income tax associated with those accounts. If you name an individual beneficiary of an income tax deferred retirement account, and that individual beneficiary is someone other than your spouse, or a minor or disabled child, that beneficiary will need to pay all of the deferred income and convert that retirement account, that income tax deferred retirement asset, into a regular investment account within a 10-year period for most people. And the effect of that can be twofold. One, you could have a retirement account with, let's say, $500,000 in it, but the deferred income tax liability associated with that might be something like $100,000. And so your beneficiary is actually getting $400,000 as an individual beneficiary rather than $500,000. Whereas if you have a charitable beneficiary and they receive a $500,000 income tax deferred retirement account, they get the full benefit of that $500,000 because they're a charitable beneficiary and they don't pay income tax. So I encourage people when they're thinking about their charitable giving and their estate tax planning to not just think about what is the dollar value of the account today, but what is the actual value of that account to the recipient. So is that account worth more to a charitable beneficiary than it is to an individual beneficiary? Is it worth more to a beneficiary because they'll have immediate access to those funds or more immediate access to those funds? Is this a type of asset that's intended to pass outright and be used, or is it an asset that's intended to go into a trust? I would offer, frankly, that most of the time, income tax deferred retirement assets are less useful and less easily used in trust. So if I'm looking at a stock portfolio held in a taxable account versus an income tax deferred retirement account, I might look at those and say, I'm going to have the taxable investment account go into the trust, and I'm going to have the income tax deferred retirement accounts going to the charitable beneficiaries so that I'm really maximizing what I'm giving each of my beneficiaries in that process. And then most people, when they're thinking about planning for charitable gifts at death, are thinking about doing it as what's called a bequest, which is a provision usually made in a will or a revocable trust. You can do either one. A revocable trust is just a will substitute. And there's several different types of bequest. The first is a specific bequest. So I give $10,000 to the Seattle Public Library Foundation. That is a specific bequest. It is paid in that dollar amount, and it is considered favored among amounts passing to residuary beneficiaries. So if your estate were insufficient to meet all of its obligations and the other beneficiaries' shares were being reduced, that specific bequest still stays as long as there's funds to pay that specific bequest. Another type of bequest is what I think of as a formula clause bequest, and these are intended to be adjustable because we don't really know exactly what our estates are going to be worth when we pass away. So formula clauses, the greater of $10,000 or 10% of my estate goes to an individual or a charity. And so that allows that if the estate increases in size for that bequest to go above the $10,000 specific amount given, or if the estate decreases such that $10,000 is now going to be a prohibitively large amount, then it'll just be the 10% of the estate. Formula clauses can be done as a specific bequest. They can also be kind of pushed into a residuary clause provision, but more often they're used in a specific bequest format. So more often they're prioritized over these residuary clauses. And then there are residuary clauses. So the remainder of my estate after the payment of expenses and taxes is the residuary of my estate. It's what's left. And so I might give 50% of my estate to my spouse, 25% of my estate to my children, and 25% of my estate to a charity. That means whatever is left after the payment of expenses and taxes, 50% will go to my spouse, 25% of that will go to my children, and 25% will go to charity. It might be the same as a $10,000 bequest, or it might be a great deal more, or it might be a great deal less. All of these bequests that are occurring in a will or revocable trust are effective on death, and they can be changed at any time prior to death. They can be highly customized. Estate planning attorneys spend a lot of time thinking about how to effectuate clients' intent in this regard. And so we've got a great deal of flexibility, and frankly, more flexibility than you'll usually see in a pure beneficiary designation. As I mentioned before, formula and residuary clauses, they take into account changes in the size of your assets between when you create your plan and when you pass. And just like any other charitable deduction, it is deductible for estate tax purposes if it's included in your will or revocable trust. Importantly here, we are only talking about assets that pass under your will or through a revocable trust. So if you have a life insurance policy that you name your spouse as the designated beneficiary of, and in your will you have a provision that says $10,000 goes to charity, that life insurance policy is not available because it's not passing under your will or your revocable trust to fund that $10,000 bequest to charity. So people sometimes get a little bit confused about which assets are going to be available to fund a bequest under a will or revocable trust. So again, it's important, as I talked about with the beneficiary designations, to really think about what your assets are, how they're going to pass. Because if you get confused and you think you have an asset available to pass under your will or revocable trust, and it is not going to pass under your will or revocable trust because you've named an individual as a beneficiary of that asset, then you won't have your intent effectuated. And sometimes I hear things like, oh, I'm going to leave my life insurance policy to my son or daughter or whoever else. And they know I want them to give it to charity. That is not an enforceable charitable bequest. So whoever you name as the beneficiary of your non-probate assets, your life insurance, your retirement accounts, those types of things, that's who takes that asset. And you don't get a charitable deduction for assets that pass to an individual. So if your intention is to benefit a charity or to have assets that are passing outside of your will or revocable trust included in the calculation of 10% of your estate, for instance, when calculating a formula clause under your will or trust, please, please, please make sure that you have your beneficiary designations lined up with your will or revocable trust, and or that you have worked with your attorney to customize how those if and linear calculations are done. It's very, very important. What are the cons of including a bequest in a will or revocable trust? And this is actually true whether it's a charitable bequest or a bequest to an individual. The first is simply that it requires a formal will or trust be executed. So unlike a beneficiary designation, which you can do and change online anytime you want, changes to a will or a trust need to be done in the format that is recognized as valid in the state in which you execute that document. And it's different in each state. So, for instance, California allows you to write up your own will and sign it. And if it's in your handwriting and you sign it, it's recognized as what's called a holographic will. Washington State does not recognize holographic wills. Instead, to have a valid will in the state of Washington, it has to be signed by the testator and witnessed by two disinterested witnesses. And you can't go back after a will or a trust has been signed and initial and cross out and make little revisions. So I've seen it happen oh so many times that someone will have a specific bequest in their will. They will go back later and cross it out or change the amount and initial it. That is not a valid will change. You have to go through the formalities of updating the will or trust with the appropriate witnesses, even for the smallest of changes. So please, please keep that in mind. The other thing about including provisions in a will or revocable trust, particularly if you're talking about including provisions for charities where you're hoping that they will have access to the funds in the relatively near future to maintain programs, is keep in mind that the distribution process for assets passing under a will or revocable trust is a bit delayed. Even if you don't have a taxable estate, we need to get through the 4-month will contest period. So after the will is admitted to probate, there's a 4-month will contest period. There's also a 4-month period for challenging a revocable trust. There's a 4-month creditor claim period. If there's a estate tax return due, that's due 9 months after date of death. And the Department of Revenue has 4 years from when that return is submitted to issue a clearance letter. Currently, as I think I said earlier, they're operating at about 18 months to 2 years. It may also be the case that the individual, or it's likely the case that the deceased individual had a final income tax return to file. So the executor, the trustee, is going to file that individual's final income tax return. And as you may be aware, we have a 3-year statute of limitations for federal tax returns. So the administration process can often take longer than people want it to. So if you are seeking to have someone immediately benefit, it's a good idea to know what your options are with your other assets to fund that. And lest there be any confusion, it's the same period of time, whether you go through probate or whether your assets pass under a revocable trust. Sometimes people will come to me and say, oh, I don't want to go through probate because it's going to take forever. The taxing authorities use the same timelines, whether you go through probate or whether you have a revocable trust. It's the same creditor claim period. It's the same will contest and trust contest period. So it's not the type of probate versus revocable trust that triggers those delays. It's whether the asset has to go through the administrative process at all. Okay, so let's talk a little bit about some fancier types of charitable giving. And I'm not going to go into a huge amount of detail on each of these, but I want to take a moment and talk about why these unusual or more complex structures exist at all. So one of the things to keep in mind is a lot of us like to donate things other than cash. If we are writing a check for something or we are handing someone cash, the value of that gift is exactly the cash amount. But a lot of us like to give things like appreciated stock. Why does that matter? Well, if I have stock in Tesla that I purchased for $1 and today it's worth $100, I have $99 of capital gain just sitting, unrealized capital gain just sitting in that stock. If I sell that stock while I own it, I'm going to recognize that capital gain and I'm going to pay capital gains tax on it on my federal income tax return. If my capital gain was more than $250,000, I'm going to pay the Washington state capital gains tax in addition to the federal capital gains tax. So instead, a lot of times what people will do is they will take highly appreciated assets and they will give those assets in their existing form as stock, for instance, directly to a charitable organization. And they get a charitable deduction for the fair market value of that stock gift. The charitable organization can then sell the stock. And again, they don't recognize capital gains tax. So one of the reasons that we have these other structures is because sometimes people want to have assets like that the charity doesn't want to receive directly. So maybe it's a stock holding that the charity doesn't feel comfortable with. Maybe it's that an individual actually wants to gift part of an operating business. So maybe you have a family business and it's going to be sold, but you want 10% of it to go to charity. It might be a good idea to transfer that business interest, but maybe the charitable organization can't take a closely held operating business. So you need some sort of intermediary qualifying charitable organization who can receive that asset. It might be that as a donor, you want a little bit more control over what happens with those funds as they go into the charity. It might be that you're trying to do that type of bunching that I talked about earlier on, where you want to make a very large gift, say once every 4 years. And then you want to dole that gift out to individual charities, in fact, over that 4-year period. But you need the big donation as a deduction that you can take as an itemized deduction on your income tax return. And so when we're thinking about some of these other types of charitable giving vehicles, it's really important to think about how they intersect with your charitable giving goals, with your income tax goals, your capital gains tax goals, and any state or local taxes that may be triggered depending on how you choose to manage either the gift or the sale of the underlying asset prior to the gift or after the gift. So what has become very, very popular in recent years is what are called donor advised funds. And these are accounts that you set up with a third-party financial custodian, so something like Charles Schwab or Fidelity. And they are a qualified charity. The fund itself is a qualified charity. You can name it whatever you would like. So I could set up the Teresa Byers Donor Advised Fund. I could set up the Hearts and Roses Donor Advised Fund. And I would set it up with one of these financial custodians, and I would make a gift to that fund. At the time I make the gift, that is treated as a completed charitable gift, and I'm able to take that as a charitable gift on my income tax return. But I am also the advisor of the Teresa Byers Donor Advised Fund, and I then tell the custodian, Charles Schwab or Fidelity or whoever else, hey, I donated $10,000 to my donor advised fund in 2026, and I would like you to distribute that $10,000 to these 2 qualifying charitable organizations. So it allows me to say where I ultimately want the money to go among qualified charities. And it's important to know this is not money that can ever come back to you. It's not money that can ever go to an individual. This can only go to qualified charities on the far end of it. But it can allow you to put more money in than you would normally give to a single charity in a year and dole it out over a multiple year period. Um, and since these are managed by, sophisticated financial custodians, sometimes they can take assets that individual charities, particularly smaller local charities, are not well suited to hold and manage. So they can be that intermediary for you to be able to sell appreciated stock or allow for a closely held business sale, or something like that. Private foundations. So donor advised funds actually grew out of the concept of private foundations. So most of us are familiar with public charities, but sometimes well-off individuals would choose to create their own private foundation, their own private charity. And these were much more restrictive than the operations of public charities. And they acted very much like what we now know as a donor advised fund, where an individual donor would put funds into the private foundation, and then the private foundation would distribute those funds to qualifying recipient charities. If you have a private foundation, however, you must comply with the private foundation rules. And that means that there's a certain minimum amount that needs to come out of the private foundation every year based upon the value of the assets it holds. That private foundation needs to be approved by the IRS through an application process, just like a public charity would need to. It needs to file what's called a Form 990 every year, and it can't engage in any self-dealing transactions. And so while loads of people love the idea of funding the charities that they love and enjoy and being able to make large gifts and then dole them out over time, with the advent of donor advised funds, private foundations have become less common simply because the administrative burden of actually managing those private foundations and complying with the filing requirements and the distribution requirements makes them a little difficult to do unless they are very, very large, unless they're funded with a lot of assets. And then the last thing I wanted to talk about were charitable lead or charitable remainder trusts. So a charitable lead trust is a trust that you create either during your lifetime or in your estate plan upon your death. And it is created with a set amount, whatever that is, $100,000 or 10% of your estate or whatever. And it exists for a set term of years. And during that set term of years, a charitable lead trust pays a certain amount every year to a charitable beneficiary. And then at the end of the trust term, say that 10-year trust term, the remainder can go to an individual beneficiary. So I could create a trust, a charitable lead trust today, in which I put $100,000 and it's going to last for 10 years. And every year it's going to pay $2,000 to a charitable organization of my choice. And at the end of 10 years, whatever is left in that trust, which hopefully is more than I put in, or at least a good chunk of what I put in because of appreciation and things like that, it's been invested, then passes to my son. Why would I do this? Well, one reason I would do this is because I get a charitable deduction when I fund that charitable lead trust. Another reason might be because maybe I don't want my child to have those assets right now, but I think he might need them in 10 years. And I really do want to benefit charity. And so I want to, help my charitable organization and effectuate my charitable goals and still have something left over for myself or my child at the end of that period. Charitable lead trusts for donor purposes work best in low interest rate environments. That's what maximizes your charitable deduction. And then the opposite of a charitable lead trust is what's called a charitable remainder trust. And it's really very similar to the charitable lead trust. It's just we flip the order in which the charity or the beneficiary take from that trust. So in a charitable remainder trust, we have an individual beneficiary during the trust term, $100,000 trust for 10 years for the benefit of my son. And at the end of that 10-year term, whatever is left in the trust passes to the named charitable beneficiary. And remainder trusts work best in high interest rate environments. That's what maximizes the charitable deduction for the donor. So those are some of what I would call the next level type planning tools if we're thinking about the continuum that we started with today. The easiest thing to do is a lifetime gift. You write that check or you transfer that stock and you see the benefits of what you're doing during your lifetime. The next easiest is probably to just update a beneficiary designation on a retirement account or a life insurance policy, maybe a pension that has a death benefit. Those can all be great ways to recognize charity upon your passing. Again, those are only effective once you've passed. You can include a charity or charities in your will or your revocable trust with the intent that they'll take from the assets passing under that document. And then you can look at some of these more advanced planning tools like a donor advised fund. And again, I would consider this a relatively accessible tool. If you use a investment advisor currently, they probably have a existing donor advised fund. You can set them up. Most of them have relatively small minimums, a couple $1,000s. And so they require a lot less administrative burden than a private foundation or a charitable lead or charitable remainder trust. So I haven't seen any questions popping up on my Q&A on this end, but I'll stop here and ask, did anyone have any questions today about anything that I've gone through? It's a very quiet group today. I'm sorry, Judith. I'm seeing it's been almost too much to take in, and that's popping up in the chat, not in the questions. But I apologize if it was too much. It can occasionally be like drinking out of a fire hose to think about estate planning. And so that was part of the reason why at the start of this, I encouraged everyone to go and talk with your estate planning attorney if you're interested in effectuating any of these tools. So I have a question from Tessa that says, can charitable remainder trusts be set up for successive individuals? E.g. college funds for nieces and nephews? No. So if you're talking about college funds for nieces and nephews, what you really want to do is set up a Section 529 account. Those are accounts that can be set up. They grow free of income tax. And as long as the funds in those Section 529 accounts are used for educational purposes, which can include room and board and fees, they're not subject to income tax on that either. Usually you can make gifts to those using your annual exclusion amount. You can set up a charitable remainder trust that lasts for a set term and benefits more than one individual. So you could, for instance, set up a charitable remainder trust that lasted for 10 years and it passed to your son and daughter. And if only your daughter was then surviving, she would receive all of it. But we don't use charitable remainder trusts and charitable lead trusts to attempt to fund Section 529 accounts. That would be complicated. They're not, those are two different types of planning tools, for instance. You could have a charitable lead or a charitable remainder trust that funded a non-charitable trust on the back end. So you could create a charitable lead trust that paid out over 10 years to a charity or 20 years to a charity or whatever it was. And then whatever was left at the end of that time went into a new trust for the benefit of, say, your nieces and nephews. And you could describe the terms of that trust as being used for education. You don't have any of the income tax benefits of a Section 529 account with those types of college savings accounts, though. Can you say again whether donations to a DAF pass through without adding to our gross income, like gifts of appreciated stock? Yeah. So if you donate appreciated stock to a donor advised fund as stock, in other words, you don't sell the stock and donate the proceeds from the sale to the donor advised fund, but if you actually transfer the stock itself to the donor advised fund, then you receive the charitable deduction. But because you haven't sold the stock, you have not triggered the capital gains and the associated capital gains tax. Um, Instead, the donor advised fund can sell that appreciated stock. Um, so that is usually what I recommend to folks is if they have highly appreciated stock and it's their intention to give it to charity, that they either give the stock directly to the receiving charity and let the charity itself sell that appreciated stock, or if they have a donor advised fund, that they give the appreciated stock again directly as stock to the donor advised fund and let the donor advised fund sell it and distribute the proceeds. But if you sell the appreciated stock yourself while it's titled in your name, so in my example with Tesla stock that's currently worth $100 and I bought it for $1, if I sell the Tesla stock, I have $99 worth of gain that I need to report. If I transfer the Tesla stock to the DAF or just even to the charitable beneficiary and allow them to sell it, then I'm not selling the stock. I'm not recognizing that capital gain myself. Um, is there a transcript of all this great info? My understanding is that this is recorded. So yes, you would be able to either listen to the recording or potentially run the recording through AI, I guess, and have a transcript created. Okay. Any other questions?
All right. Thank you so much, Teresa, and thank you everyone for your good questions. We have officially wrapped up Q&A, and so first I would love to give a momentous thank you to Teresa Byers for sharing her time, expertise, and thoughtful insights on charitable giving. So thank you so much, Teresa, for joining us again here at our Plan Giving webinar. And we hope that you found this session helpful and inspiring. We will send a follow-up email with the recording and slides in the next couple of days. So yes, you will receive all this great information. So keep an eye out for that. And as you exit the webinar, as I mentioned, you'll be invited to complete a short survey, and we really hope that you can take a moment to do that and get entered into a fabulous prize drawing to win a bag of books. And then as you reflect on your own legacy planning, we really hope that you will consider how a charitable bequest can support organizations you care about, including those that promote literacy and create meaningful community experiences like the library and town hall. We're truly grateful for your support, and if you've already included us in your plans, we'd love to know that so that we can thank you and help ensure your wishes are honored. If you have any questions or would like to continue the conversation, please reach out. Our contact information will be on the next screen. And with that, I thank you again for being here today, and we hope you have a wonderful afternoon.